Welcome to the Deep Dive, your express ticket to being well-informed on the biggest market stories. Today, we're digging into the second quarter 2025 earnings call for Dayforce, the human capital management company.
Yeah, and this one's particularly interesting. It wasn't just a strong quarter, though it definitely was that. It really felt like the performance set the stage for, well, some pretty massive M&A news that followed.
Exactly. So we're going to unpack that performance, look at their AI strategy, which is key, and then, connect it all to that big take-private deal.
It's a great case study, really. A company builds solid fundamental value, gets its strategy right, and boom, the market, or in this case, private equity, takes notice.
Right. Let's show how that operational strength made them such an attractive target. Okay, so first things first. The Q2 numbers, just a really solid beat across the board, wasn't it?
Absolutely. They blew past guidance everywhere. Non-GAAP EPS, that came in at 61 cents.
Yeah, and consensus was looking for, 52.10, so that's a $1.09 beat, 17% ahead. Pretty substantial.
Definitely not just scraping by. And revenue followed suit, $464.7 million. That was above the $458 million consensus, so about a 1.4% beat there.
And the year-over-year growth looks healthy, too, 9.8% overall.
Right, but even better if you look at it ex-float, that's 11.5% growth year over year.
Good point. Just remind us quickly, float revenue is?
Yeah. It's basically the interest income they earn on client funds held temporarily, mostly for payroll. So excluding it gives a cleaner picture of the core software and services business growth.
Gotcha. And profitability, that looked like a standout, too.
It really was. Adjusted EBITDA hit $147.2 million. And the margin, that's the key part, reached 31.7%. That's a huge expansion, 420 basis points year over year.
Wow, 4.2 percentage points up. That really shows they're getting more efficient, squeezing more profit out of each dollar of revenue.
Exactly. And the core recurring revenue, again, ex-float, that was up 13.6%. 14% if you adjust for currency changes, $315.5 million there.
Solid recurring growth. And what about cash flow? That often tells a deeper story.
Year to date, free cash flow, FCF, was strong, $106.6 million. That's an 11.3% margin for the first half, up 500 basis points from last year. So definitely generating more cash.
Okay, so strong numbers, clear momentum, but you mentioned the initial market reaction was a bit muted.
Yeah, it was kind of strange. Pre-market, the stock actually dipped a little bit, despite the beat.
Any theories why? Maybe guidance subtleties or just broader market jitters?
Could be. Maybe focus on Q3 margin guidance, which was slightly lower sequentially, or just macro noise.
Yeah.
But honestly, it didn't last long.
Right, because the external news just completely took over the narrative.
Exactly. But before we get to the M&A drama, let's stick with why Dayforce was looking so good fundamentally.
Yep.
That initial caution definitely faded fast.
Okay, so back to the operations. That EBITDA margin expansion wasn't an accident, was it?
No, not at all. Management's been talking about balancing growth and profitability for a while. This is the proof. Operational efficiencies, disciplined spending, it's all contributing.
And that discipline flows right through to cash flow. Q2 FCF was, $87 million?
$87.1 million, yeah.
Yeah.
Which works out to almost 19% of revenue just in that quarter. Really strong conversion.
And that led them to raise the full year FCF guidance.
Yep. They bumped the FY25 FCF margin guide up from 12% initially to a new range of 13.5% to 14%. That's a significant hike mid-year.
What was the big driver behind that confidence boost on FCF?
Well, a really big piece actually was legislative, the One Big Beautiful Bill Act. Bit of a name, huh?
Yeah. What did that do?
It passed in July 2025, U.S. legislation. It changed the rules for R&D tax deductions. Now, companies can immediately expense domestic R&D costs rather than amortizing them over time.
Okay, so that pulls forward tax savings.
Exactly. For Dayforce, they estimated it provides a $40 to $50 million cash tax benefit just in 2025.
Wow, that's substantial.
And then around $20 million annually after that. So it's a significant kind of structural improvement to their cash flow profile going forward.
Okay, so a nice legislative tailwind.
Yeah.
But it wasn't just that, right? They mentioned something about incremental margins.
Right. They pointed out that year to date, their incremental FCF margin on incremental revenue was 57%.
Meaning for every new dollar of revenue they brought in, 57 cents dropped to the free cash flow line.
Very much. Shows the underlying business is just becoming much more efficient at converting growth into cash.
And that feeds into their long-term goals, I assume?
Definitely. They reaffirmed that $1 billion FCF target by 2031. And you could hear the increased confidence given the current performance and that tax benefit kicker.
Anything else notable on the revenue side? Professional services.
Yeah, that's all good growth too. Up almost 23% to $71.6 million.
And that's important because...
Because prof services often leads recurring revenue. It's the implementation work, the setup. When that's growing strongly, it usually signals a healthy pipeline of future software subscription revenue.
Makes sense. And they were buying back stock, too.
Yep, about $20.8 million worth in Q2. Takes the year-to-date total over $51 million, returning some of that cash to shareholders.
Okay, so the financial engine is humming. Let's pivot to the strategy, particularly the AI aspect. They're really leaning into this AI people platform idea.
They absolutely are. It feels like the core of their whole pitch now.
Yeah.
Not just another HCM vendor, but the integrated AI-powered solution.
And they're backing it up with actual products, not just concepts.
Yes, that's the key. They talked about the Dayforce AI assistant, plus a roadmap for over 30 specific AI agents. 2 are already rolling out this month. A pay discovery AI agent and a contextual writer agent. That last one uses generative AI for things like writing performance goals or job descriptions.
So practical applications. Are customers buying into it?
The adoption numbers suggest they are. Over 50% of new deals included the AI assistant.
Wow, half of new wins already.
Yeah, and nearly 100% included the broader AI people platform concept. Over 80% took AI analytics, nearly 60% took AI learning products. It's clearly resonating.
What's giving them the edge here? Why is their AI potentially better or more integrated than competitors?
This is crucial. It comes back to their architecture, the single data model.
Explain that a bit more.
Okay, so Dayforce handles basically everything. Payroll, time, HR, benefits, talent on one unified platform with one database underneath. Compare that to competitors who might have acquired different pieces or use separate modules that are only loosely connected, sometimes called federated systems.
So Dayforce's data is cleaner, more consistent.
Exactly. And for AI to work well, especially predictive or analytical AI, it needs really good, comprehensive, well-structured data. Dayforce argues their single data model provides that foundation inherently, giving them a big advantage over systems trying to stitch together data from multiple places.
That makes a lot of sense. Data is the fuel for AI.
Precisely. They also mentioned delivering the Dayforce Experience Hub on mobile, targeting frontline workers, and keeping up with compliance, over 230 updates there.
So this unified platform, the AI layer, it all feeds into their sales pitch, right? The 12-to-1 consolidation.
Absolutely. That's their big value proposition. They go to a potential client who's maybe using a dozen different HR tools, one for payroll, one for time tracking, another for recruiting, et cetera, and say, we can replace all of that with our single platform.
The benefits being?
Streamlined operations, obviously. Lower costs from managing fewer vendors, reduce operational risk because data isn't being manually transferred between systems, and hopefully a better employee experience with one place to go for everything.
That's a compelling pitch. Is it translating into sales momentum?
Seems like it. They reported bookings growth over 40% year to date. And get this, it's the 3rd consecutive quarter they've achieved that level of growth.
Over 40% bookings growth for 3 quarters running. At their scale, that's really impressive.
It really is. And it's broad-based. They're getting high attachment rates on full suite deals, over 90% for new enterprise, and major market customers are taking the whole platform.
And the AI is pulling its weight in sales, too.
Yep, over 50% attach rate for the AI assistant in new wins, as we mentioned.
What about selling more to existing customers? Is that working?
Big time. Client-based sales, or back to base, grew over 50% in Q2. That now makes up 40% of their total bookings.
So they're successfully upselling and cross-selling.
Yeah, and management sees a lot more room to run there. They mentioned the average PPM per employee per month revenue is still only around $13. That suggests many clients haven't bought the full suite yet, leaving plenty of runway.
Any other growth drivers? Managed services? Partners?
Both strong. Managed offerings, like where Dayforce runs payroll for the client, were added to 17% of new deals, and bookings for those services more than doubled year over year. And the system integrator channel is on fire. SI-led sales grew 80% in the first half. SIs were leading 45% of new projects in Q2, up from 35% the year before. So partners are definitely amplifying their reach.
Okay. Strong growth drivers across the board. Did they mention any specific big wins?
Oh, yeah. Some major ones. The Government of Canada officially selected Dayforce for a huge HR and pay modernization project. That's massive validation, especially in the public sector.
Wow, yeah, federal government deals are usually complex and very sticky.
And they talked about their largest go-live ever. A client with over 300,000 employees went live in Q2.
300,000, that's enormous.
And it's expected to grow to over 500,000 employees by year-end. They suggested it might be the largest cloud-based federal solution operating at scale, period.
Incredible scale. Any others?
Yep, a global apparel company, 37,000 employees, where they displaced 8 other vendors. A U.S. infrastructure services firm, 10,000 employees, dealing with over 300 unions, talk about complexity. And a multinational industrial company. It shows breadth across industries and ability to handle really complex situations.
Okay, so momentum is clearly strong. What was the guidance they issued before the M&A news hit? Let's quickly cover their outlook then.
Right, the updated FY25 guidance, they were projecting total revenue between $1.935 and $1.955 billion.
And ex-float.
$1.749 to $1.769 billion. That implies 14% growth in constant currency for the core business.
And the recurring piece.
Dayforce recurring ex-float guided to $1.324 to $1.344 billion. That's 17% constant currency growth. Very strong.
With margins holding up.
Adjusted EBITDA margin guided at 32% for the full year. And FCF margin, as we said, lifted to that 13.5–14% range.
Okay, that's the full year. What about Q3 specifically?
Q3 total revenue guidance was $476 to $486 million. Dayforce recurring ex-float, $329 to $339 million. Adjusted EBITDA margin for Q3 expected between 30% and 30.5%, slightly lower than Q2, which might have been that initial point of caution for some investors, but still very healthy.
And they expected growth to pick up again after Q3.
Yeah, they explicitly guided for Dayforce recurring ex-float growth to accelerate into Q4, hitting 16–19%.
Why the expected acceleration?
Just the timing of those big deals they've been winning going live. Strong bookings translating into recognized revenue. They said their work in process, basically sold deals waiting to go live, is the biggest it's ever been.
Okay, so the outlook was decidedly positive, reaffirming long-term targets above 15% growth.
Exactly. Confidence seemed high based purely on the operational momentum.
All right, now let's bridge this to the big event, the investor context. So shares dipped slightly pre-market after earnings?
Right. Maybe 2.7% down initially, but they recovered during the day to close slightly up, about 0.36%. So maybe just some noise.
But that minor wiggle became totally irrelevant just a few days later, didn't it?
Completely. August 18th, reports surfaced about a potential bid from Thoma, the big private equity firm.
And the stock reaction?
Jumped 26%. Just huge.
And then it became official.
Yep. August 21st, definitive agreement announced. Thoma taking Dayforce private for $12.3 billion, which works out to $70 per share in cash.
So overnight, the investment thesis completely shifts. It's no longer about forecasting next quarter's earnings.
Exactly. It becomes about the deal closing. What's the spread between the current price and $70? What are the risks, regulatory approval, shareholder vote? The deal's expected to close early next year.
But that offer itself, $12.3 billion. That's a massive statement, isn't it? A huge validation of everything we've just talked about.
Absolutely. It validates the strategy, the platform strength, the competitive position against giants like Workday, SAP, ADP. Thoma clearly saw the value being built and decided it was worth paying a significant premium for.
Did management comment on the broader economic environment during the call?
They did. They described it as a strong buying environment in their target market. Typically companies with 500+ employees, especially those with lots of frontline workers in sectors like retail, hospitality, manufacturing.
And employment trends.
They said employment within their existing customer base was up just under 1% year over year, a bit slower than the historical 2% they usually see, but still positive growth. FX rates also turned into a slight tailwind, helping guidance a bit.
Okay, so a strong operational story gets capped off by a major validation from private equity.
All right, let's shift gears to our favorite segment. Time for the Not Financial Advice Trade Idea Corner. Remember, everyone, this is purely informational, a thought experiment, definitely not a recommendation. Standard disclaimer applies. But given the situation, the obvious trade, if you believe the deal will close, is simply buying the stock below $70 to capture the remaining spread. That's the arbitrage play.
Right, the relatively safe bet. But we like outrageous but plausible, so let's speculate a bit more wildly.
Okay, let's stretch the scenario. What if $70 isn't the final price?
Exactly. Here's a potential structure. Again, just spitballing. What if you sold some out-of-the-money put options? Maybe with a strike below $65, expiring shortly after the expected deal close date.
Okay, so selling puts means you collect premium upfront, betting the stock won't fall below $65. That's a bet on the deal closing smoothly. or at least not collapsing entirely.
Right. High confidence in the floor set by Thoma. But then simultaneously, you use some of that premium or add a bit more capital to buy some further out-of-the-money call options. Say, strikes around $75 or $80 with a similar expiration.
Ah, okay. So the puts express confidence the deal provides a floor, and the calls are a lottery ticket on
What?
A competing bid?
Precisely. It's a long shot, but is it completely impossible? Dayforce has this strong AI platform story, the single data model, clear path to $1 billion in FCF, huge government contracts.
It's a very attractive asset in a hot sector. You could argue another large PE firm, or maybe even a strategic buyer like an Oracle or Salesforce wanting to bolster their HCM offering, might look at the $70 price and think, maybe there's still value.
Right. If a bidding war, however unlikely, were to emerge, those cheap $75 or $80 calls could potentially explode in value.
It gives you asymmetrical upside. You collect premium from the puts, betting on the likely outcome, deal closes near $70, while buying a cheap chance at a much higher price if something unexpected happens.
Highly speculative, depends on your view of M&A dynamics and Dayforce's unique appeal. But that's the outrageous but plausible angle, selling confidence, buying optionality.
A fun structure to think about, definitely.
Okay, so let's wrap this deep dive up. To recap, Dayforce delivered a really outstanding Q2, beat expectations, showed strong growth, especially in bookings.
And really pushed forward that AI people platform strategy, leveraging their core data advantage. Adoption numbers looked great there.
They significantly raised the free cash flow guidance, helped quite a bit by that one big beautiful bill act on R&D taxes, but also driven by strong operational execution.
And then, of course, the big news. While the market initially hesitated slightly on earnings, that was totally eclipsed by the definitive $12.3 billion take-private deal with Thoma at $70 a share.
A deal that really validates their strategic direction and market position, expected to close early next year.
So, as always, remember, everything we've discussed is just for informational purposes. It is absolutely not financial advice. Please do your own research and consult with a professional.
Definitely. It really makes you wonder, though, going private, away from quarterly scrutiny, could Thoma unlock even more potential? Maybe accelerate that AI roadmap even faster? Food for thought. We'd love to hear your thoughts on the quarter and the acquisition. Until next time, happy investing.